Hello everybody, welcome to today's class. My name is Dr. Bahaudin Mujtaba, and today we will talk about the pay model. So compensation is obviously a very complex discussion in any human resource management class. Compensation is complex because it deals with our needs, our wants, our preferences, and obviously our qualifications, our abilities, and how hard we work. So let us begin by talking about what pay actually means and how paying people in different ways can influence them and in return create organizational success. We will describe the compensation policies and techniques that organizations use in the multiple objectives that organizations hope to achieve by effectively managing these compensation decisions. The aim is to understand how compensation strategy decisions actually interact with the specific context of a company or a business and its human resource strategies to actually influence the company's overall success. The pay model provides a structure for understanding compensation systems. There are three main components of the model. First is the compensation objectives, which include the importance of ethics in our decision making. And number two is policy decisions that guide the way objectives will be achieved. And finally, the third element is the techniques that make up the pay system. With regards to the pay model, please pay close attention to the various elements of this comprehensive model related to the policies, to the techniques, and to the overall objectives, which are explained in the first chapter. But keep in mind that the model continues throughout all the chapters in the textbook. So try to understand the various parts or various elements of this model related to the three elements of policies, techniques, and objectives. So as you're reading future chapters, you can see how it fits into the overall comprehensive pay model. So we will examine four main policy decisions, which include internal alignment, external competitiveness, third, employee performance, and finally, management, as well as the various techniques and some of the new directions in related research that has gone into compensation and how we're actually paying people and how those payment decisions have been changing over the past few decades nationally as well as globally. The learning objectives for this chapter are to compare the benefits of a well-designed compensation system to the detriments of poorly designed compensation systems. And we're also going to have another objective, and that is to define compensation from the perspective of society, stockholders, the company or the institution or the organization, and finally, the external environment. We will also examine the various forms of pay, which include cash compensation, benefits, total earnings, opportunities, and relational returns from work, as well as understand the various components of the pay model, which could include compensation objectives, policy choices, as well as the pay techniques that are being used in the modern workplace. So compensation, does it matter? If so, why? If it does matter, so what? Well, the role of poorly designed compensation plans in the economic downturn periods can be analyzed from different perspectives. Companies that have failed in recent times had labor costs that were much higher than their competitors in the marketplace, and they did not have the corresponding advantages in terms of efficiency or quality of their products or service, and even customer service in general. Examples of these companies that have not been able to compete effectively have been companies like Chrysler and even General Motors, where their pay system did not produce the competitive advantage that they were seeking. On the other side, successful companies have had relatively high pay as well as higher productivity compared to their competitors in the marketplace. One example that's mentioned by most researchers, including your textbook, is the Nucor Steel. Wall Street financial services firms and banks have used incentive plans that reward people for developing innovative new financial investment vehicles and for taking risks to earn themselves and their firms a lot of money. Sometimes we consider that greed, which can go a little bit beyond what is considered to be appropriate or socially responsible in a way. When the markets discovered that many of these high risks had gone bad, the firms either had to file for bankruptcy or they had to just wait around until some other company took them over. Obviously, you may have seen over the past 2 decades that the US Congress and the President thought greater expertise in the design and execution of these compensation plans would actually have been able to control excessive risk-taking or maybe irresponsible risk-taking and prevented those problematic behaviors while promoting a positive atmosphere or culture within the organization. So the resulting legislation was the Troubled Asset Relief Program, otherwise known as TARP, which included restrictions on executive compensation and also discouraged executives from taking unnecessary and excessive risks. We need to keep in mind that how people are paid impacts their behavior in their departments or in their companies overall, which in return impacts the organization's overall success. For most employers, compensation is a major part of the total cost, and often it is the single largest part of the operating cost. So a well-designed compensation system can help a company or an organization achieve and sustain a competitive advantage over time. On the other side, a poorly designed compensation system can unfortunately play a major role in undermining organizational success and obviously sustainability. So what is compensation? People's view of compensation differs depending on whether they look at compensation from the perspective of a member of society in general, from a stockholder's perspective, from a manager's perspective, or from an employee's perspective when we're working at these different organizations or institutions. So we can analyze the definition and importance of compensation from different perspectives, including society, stockholders, management, as well as workers in any type of organization. So let's look at it from society's perspective first. Some people see pay as a measure of justice. For example, comparing earnings of women with those of men, which highlights the potential inequalities or inequities that have existed over the past century or so. For example, if you compare the wages of females in 2016 compared to today's environment, you'll probably find that there has been some improvements. However, the improvements might be very, very minor. On the other hand, if you look at the wages of people over the past 4 or 5 years and compare them to, let's say, 4 decades ago, we have made some improvements of about 20%. In 2016, among all of the full-time workers in the United States, women earn about 80 to 82% of what men earned, which was actually an increase from 1979, which at that time it was about 60% of what men earned. So there has been some improvements. However, today, if women had the same education, same experience in union coverage as men, in work in the same industries and occupations, the ratio could increase as high as maybe 90%. But still, we would have that sizable 10% difference, which is obviously unfair when men and women are doing the same job under the same qualifications, yet women would receive 10% less. Society has taken interest in these types of earning differentials between men and women by introducing certain laws and regulations that are aimed at eliminating the role of discrimination in causing these gaps between the two genders. Benefits given as part of total compensation may also be seen as a reflection of societal equity or justice. Civilian employers spend about 46 cents for benefits on top of every dollar that is paid for wages in salaries. For state and local government employers, it's even a little bit higher, about 60 cents. Job losses or gains in a country over time are partly a function of relative labor costs, like productivity across countries. For example, the hourly total compensation for Mexican manufacturing workers seems to be about 10% of those that are paid for the US manufacturing workers in today's environment. However, the value of what is produced is also something that needs to be considered. For example, Mexican worker productivity is at about 34% of the US workers, perhaps because of maybe efficiency or use of modern technology, or maybe the learning curve is greater for the US workers compared to the Mexican manufacturing environment. Some consumers know that pay increases often lead to price increases for them. So consumers do not necessarily believe that higher labor costs benefit them. On the other hand, other consumers lobby for higher wages. As you've seen over the last 10 years, we've seen a lot of people go on strikes or at least protesting that hourly wages for, let's say, certain fast food places should be raised to $15 per hour as opposed to the traditional $9 to $10 where most workers are earning in the US. Let us also look at it from the stockholders' perspective. So stockholders differ on their views of whether employees should be given stock options or not. Supporters of this view believe that offering stock options creates a sense of ownership that will improve the performance and eventually increase stockholder wealth. Opponents, however, argue that granting employees too much ownership dilutes stockholders' wealth. So stockholders have a particular interest in executive pay as well, to the degree that the interests of executives are aligned with those of the shareholders, for example, by paying executives on the basis of company performance measures such as shareholder return. The hope is that a company performance will actually be higher. In the absence of a linkage between executive pay and company performance, concerns rise that the executive can somehow use their influence to obtain high pay, but without necessarily performing well. Data on chief executive officers' compensation shows that the large total annual compensation of $11 to $10 million annually in the bulk of compensation are connected to the shareholder return or short-term performance measures. So we cannot expect changes in the CEO wealth and shareholder wealth to be aligned. Shareholders, however, do influence, and they can influence executive compensation decisions through shareholder proposals in election of directors through proxy votes. In addition, we see that the Dodd-Frank Wall Street Reform in Consumer Protection Act of 2010 did have a provision of say on pay, which required public companies to submit their executive compensation plan to a non-binding vote by shareholders. Let us look at it from a manager's perspective in terms of how they see compensation. Managers view compensation as influencing their success in a couple of different ways. First, compensation is a major expense, obviously, that needs to be managed effectively. Competitive pressures force managers to consider the affordability of compensation decisions, since labor costs do account for more than 50% of total cost in most firms. Some industries could even be higher than 50% total cost. So labor cost as a percentage of total cost can vary among individual firms and obviously industries. Think about the mama and papa neighborhood grocery store, where the labor cost seems to be around 15 to 18%, but unfortunately they've been run out of business by supermarkets, especially the giant chains, with lower labor cost of anywhere around 8 to, let's say, 12, 13%. So those 3 to 5% lower costs can make a huge difference in competitiveness and sustainability of a business over time. And now that we see Amazon has entered grocery sales, it will cause more cost reductions in disruptions in the retail environment. The researchers have compared the hourly pay rate for retail workers at Costco to that of Walmart and Sam's Club. So you've seen this data over and over again in newspapers, and even textbooks do discuss them as well. Costco has chosen to pay higher wages to attract and to retain higher quality workforce. So that means people who have experience, they stay a little bit longer, which can give a firm a competitive advantage because of experience that accumulates over time. Costco is quite successful in terms of employee retention, customer satisfaction, and the efficiency with which it generates sales. Second, compensation is a major determinant of employee attitude and behaviors, and ultimately a major determinant of organization's overall performance as well. A manager can use pay to influence employee behaviors while also improving the organization's performance. So high pay, if it brings high return as well, is one strategy that some managers like to use. Pay affects quality of the employee's work, their attitude toward their customers, their willingness to be flexible and to learn new skills or even to suggest innovative ideas. In other words, high pay would encourage employees to be actively engaged with the organization. Now let's look at it from the employee's perspective. We're all workers of some sort. Some of you as workers might have management responsibility, leadership responsibility, or team development responsibility, but nonetheless, we're all employees at some capacity. So for employees, pay is a major source of financial security. Unless obviously if you're Warren Buffett or Bill Gates, that's a little bit different, or even Mark Zuckerberg or most of these other CEOs that have earned millions of dollars. So financial security may not be a big issue for those individuals, but for most of us, it is obviously a primary reason for selecting a specific company or industry where we work. So employees can view compensation as a return in exchange between their employer and themselves. Employees view compensation as an entitlement for being an employee of that specific organization or institution or government sector or company. Employees view compensation as an incentive to take a position with a specific company or industry, or even to stay in a job and invest in performing well. Or employees see compensation as a reward for having done a good job with an organization. So compensation can be all of these things to an employee that I've given you so far. Let us now look at incentives in sorting effects on pay on employee behaviors. Pay influences employee motivation and behaviors in a couple of different ways at least. Pay can affect the motivational intensity, the direction in the overall persistence of current employees. Motivation, together with the employee's ability as well as the work and organizational design, seems to determine employees' behavior and their overall performance. This effect of pay is known as what we call incentive effect, the degree to which pay influences individual and aggregate motivation among employees we have at a given time. But pay can also have somewhat of an indirect but important influence via what is known as a sorting effect on the composition of the workplace. So that is that different types of pay strategies can cause different types of workers and professionals to apply and stay with the organization. It's not only how much or how a company pays that results in a sorting effect. People differ regarding which type of pay arrangement they prefer. The question for organizations is simply this: are you using the pay policy that will attract and retain the types of employees that you want for your department, for your overall culture? Focusing only on the incentive effects of pay can actually miss the other major mechanisms of sorting by which pay decisions influence employee behaviors. The pay model includes compensation policies and the objectives of efficiency, fairness, as well as compliance, and these are meant to influence behavior. Ultimately, these policies and techniques should be aligned with the overall objectives of the pay model, focusing on efficiency, fairness, compliance, and ethics. So also the efficiency has the components of performance, quality, customer, and stockholder in the overall cost. So compensation policies work through employee incentive as well as the sorting effects to either achieve or maybe not achieve the overall organization's objectives. Let us look at compensation from a global perspective for a few seconds. In English, compensation usually means something that counterbalances, offsets, or makes up for something else. However, in China, the traditional character for the word compensation are based on the symbols for logs in water. Did you know that? Well, it means that compensation provides the necessities of life in China. In the recent past, compensation was viewed as an entitlement for the Chinese. However, today, a new word pronounced something like dai yu is used to refer to how one is treated with respect to wages, benefits, training opportunities, and so on. So the contemporary meaning of compensation in China includes both returns as well as entitlements. Compensation in Japanese is pronounced something like kiyo, which means giving something. Traditionally, compensation was viewed in Japan as something that was given by a person's superiors, managers, supervisors, or obviously people on top, the leaders. Today, however, the word pronounced something like hu xiu, which means reward, is used. It has no association with the notions of superiors. Tiate, which means taking care of something, is regarded as compensation, which takes care of employees' financial needs in Japan. It includes the many allowances that are still being used in most Japanese firms, like family, housing, and sometimes commuting allowances, which are needed by employees. Contrasting these various ideas about compensation, or multiple views with multiple meanings from around the world, do add some richness to the topic of paying or compensation of our employees. So to minimize confusion, in our class we will use the definition of compensation that is provided in the textbook. So in the textbook, compensation basically refers to all forms of financial returns, intangible services, and benefits employees receive as part of an employment relationship in the organization or in the institution. So compensation would be all forms of financial returns, intangible services, and benefits employees receive as part of their employment relationship with the organization.